Hello everybody, this is Chuck Carnival, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Dividend Kings marketplace on Seeking Alpha. And this is a video that I'm producing on Cardinal Health. Depending on whether you measure it in total revenues or market cap, it's either the second or third largest drug distributor or medical distributor in the country, and a company that I wrote about in November of 2017. And at the time I wrote an article that said that it was a Dividend Aristocrat that was on sale. This is approximately when I wrote my last article. And as you can see, if you look at it from the standpoint of what's happened since then, the price has continued to drift down. But another reason I'm showcasing this, we're going through this horrible pandemic, the coronavirus, of course, and it's devastated our economy, devastating our stock market. But what I want you to notice here about this particular company, even though it hasn't performed on a capital gain basis very well since I wrote the article back in November, it's only been 2.5 years, and I tend to be a long-term oriented investor. Actually, I invested in the company for its dividend and wrote about the company for its dividend, and the dividend has grown nicely. It's grown from $1.81 a share in 2017, raised it to $1.86, then to $1.91 last year, and it's expected to be $1.95 this year. So the dividend growth more recently hasn't been that great, but it has been growing. And I'll show you here in a moment, the company I do believe has ample cash flows, both operating cash flow and free cash flow, to continue supporting that dividend growth going forward. But I want to make another point. Another reason I'm sharing this is because of the pandemic. I've often said it's a market of stocks and not a stock market. So I'm looking for companies that are, number one, not going to be as dramatically affected as some industries and some companies like airlines, hotels, restaurants, casinos, cruise lines. These are types of industries and companies in those industries that are going to just be devastated as a result of this, mandatory shutdown of our economy. But we should keep in mind that the economy was actually quite strong coming into this. And there's also talks about, referring it to it's going to be worse than the Great Depression. Well, the Great Depression occurred during a time when we were primarily an industrial economy. Things are an awful lot different today. Our economy since those era has become a lot more productive. There's a lot more federal safeguards in place. And I just really don't see us going into a Great Depression. But nevertheless, there are companies that are going to suffer as if they were in a Great Recession or certainly Depression. And the beauty of Cardinal Health right now is, as a medical distributor, I believe the company is actually seeing some growth, some strong business results as a result of their medical distribution business. Therefore, unlike many other industries and businesses, the company is actually expected to see pretty decent earnings growth going forward, and I expect the dividend to continue to grow as well, because there are other factors affecting the dividend. And this is something that I'm looking for in today's marketplace. Companies that might be actually, as morbid as it sounds, benefiting from the pandemic. I also want to look at companies that have good, strong cash flows. And Cardinal Health, I'm not so much worried about price to cash flow here, so I'm going to take price off of the graph. What I want you to see is they've got cash flow. Operating cash flow is, heavily covering the dividend. In fact, their dividend operating cash flow payout ratio is only expected to be 25 to 26% this year, and even next year it should only be about 30%, although analysts are anticipating a slight drop in operating cash flow. But cash flow is what the dividend is all about, so I consider the dividend to continue to be secure. And from a free cash flow point of view, I see very, very similar numbers. We've got very strong free cash flow coverage of the dividend, so I consider this to be a very safe dividend. We can currently buy the stock with a 3.84% yield. I'm going to go back to the earnings now, because this is where I really rely on valuation most, but the dividend is very well covered. So when I look at the price relative to earnings, I want to make a couple of points here that I think are very, very important. I felt the company was undervalued back in November of 2017 when I first wrote about the stock. And it actually did rally pretty strongly for a few months. And then, of course, we were dealing with the opioid epidemic. And so as a result, the stock and the whole industry has been kind of weak. Cardinal Health also had a weak operating earnings year in 2018. Their earnings actually dropped 7%, but then in 2019 they recovered up to 6%, and they're expected to be up about 1% this year. But again, part of that has to do with the strength of the medical distribution products that the company's offering, things like gowns and so on to protect our healthcare workers. But the real point is, since this pandemic has kind of reared its ugly head, I want you to notice that the stock has actually held up extremely well, way better than most companies have, and I do think it continues to be significantly undervalued. So assuming this would go back to some normal price-earnings ratio, and let's look at the company from the price-earnings ratio. I'll add the blue line, which is the normal price-earnings ratio for this stock on the graph. And I want you to notice this is historically a 14 to 15 times earnings company. It's currently traded at a blended PE of 9.4, which offers us the inverse of that, or the earnings yield of 10.6%. And as I indicated earlier, a 3.84% dividend yield. So when I look at this company going forward, there is still an opportunity to generate significant rates of return, annualized rates of return, even as high as over in excess of 30% out for the next couple of years. And that's just assuming that the stock trades at a normal PE ratio. And I referred to that in my first article. You know, I'm looking for PE expansion and growth. Now, we've owned the stock here since 2017. That's about a 2.5-year time frame. I, feel like you should always be looking to own a stock for at least 5 years or 10. As Warren Buffett says, if you don't expect to own a stock for 10 years, you shouldn't expect to own it for 10 minutes. Because the problem is, if you look at earnings here, you can see that they're relatively stable. If you look at dividends, you can see that they're extremely stable. So the predictable parts of the stock, the fundamentals that I was interested in when I wrote the first article, have remained intact and are strong. The company's generating good cash flows. The company has a strong cash position, by the way. If I go off to fund graphs here, financial underlying numbers, you can see that as of the June 2019, they had $2.5 billion in cash. Their quarterly cash of December, that had $1.6 billion in cash. And then I think more relevant to what I'm really talking about here, if I look at revenues, their revenues have grown very nicely. I'll go back to yearly revenues, and you can see that their revenues have increased year after year. So the company, from a standpoint of cash flows and revenues and the things that I think are really important to investors, the company's doing fine. I do consider the stock significantly undervalued, just like it was back here in the Great Recession, which was a great time to buy the stock. It's growing now. It's going to do well and probably have better operating results than most companies as a result of this pandemic. So, I'm content. I've gotten my dividend increases. My income has increased each year since I've been owning the stock. I'm very happy about that. I'm patiently waiting for the capital appreciation to eventually kick in. I think it will, and I think right now it's even a more higher certainty than it was when I first wrote about the company. Anyway, this is a really interesting opportunity. It's a Dividend Aristocrat. They've increased their dividend for over 30 years. I think they're going to continue to increase the dividend this year and forward years. So it's something you might want to take a closer look at and do your own research before you lay your money down. Anyway, this has been Chuck Carnevale saying thanks for watching. If you like what you saw here and looking for good dividend ideas, you might want to check out our Dividend Kings marketplace service on Seeking Alpha. Anyway, thanks for watching. Appreciate it, and stay safe, everybody, and God bless. Let's hope that this pandemic is soon coming to an end and we can start turning our economy around. In the meantime, stocks like Cardinal Health are being part of the solution rather than just part of the problem. Thanks for watching.